You know that sinking feeling when you open your portfolio and one of your favorite investments is just sitting there? That's been the vibe for a lot of SCHD investors this year. I get it. But before you rage sell and move your money into whatever's trending, let's understand what's really going on with SCHD. A few months back, I felt good about my dividend ETF until suddenly the music stopped. Growth stocks were soaring while SCHD felt stuck. Instead of dumping shares, I decided to go full detective mode and understand why this ETF, based on quality and income, seemed static. This rabbit hole completely changed how I view SCHD today. On the surface, around $27 to $28 a share and a 3.7% dividend yield. Not bad, but compared to Treasury bills, it looks lackluster. SCHD was designed for reliable income and steady growth, not for chasing momentum or flashy charts. This year looks worse than usual due to March 2025's big portfolio reshuffle, changing roughly 20% of its holdings. Energy now constitutes over 21% of the fund, up from about 12% last year, with key players like ConocoPhillips and Schlumberger. While retail investors might groan about oil before a downturn, institutional investors see opportunities. Energy companies are trading at attractive valuations in over a decade. They may not be glamorous, but they throw off massive free cash flow. These are not struggling companies. They're just unpopular right now, and that's an opportunity. In 2020, no one wanted energy stocks, but as oil prices rose, those unloved stocks outperformed. Let's address the elephant in the room. Why own SCHD when a 4% savings account is available? Savings accounts are safe, but they don't grow purchasing power. Inflation eats away at gains. SCHD offers dividend growth and capital appreciation, essential for outpacing inflation and building wealth. Contrarian positioning gets interesting. By increasing its energy exposure while dialing back financials, it's zigging while many dividend ETFs zag. While others like VIG and VYM lean harder into banks and healthcare, SCHD is doubling down on sectors that are deeply out of favor. These sectors are lagging while everyone piles into tech and AI. The market is a pendulum, and overlooked sectors will rise again. Investors often fixate on price action, but total return, including dividends, paints a different picture. Even in a bad year, SCHD pays about 3.6% in income. Reinvesting dividends allows for compounding, building wealth over time. Over the last 18 months, my SCHD position showed a subtle but powerful truth. My total return, with dividends reinvested, was slightly positive. I've accumulated more shares without adding new money. That snowball effect is the heart of dividend investing. Institutional investors aren't panicking. They're accumulating because 6 months of underperformance means nothing if your horizon is 10 or 20 years. SCHD holds companies with strong cash flows, healthy balance sheets, and a long history of paying dividends. It's diversified across essential industries. When thinking long-term, you want hated sectors with attractive valuations and a reliable income stream that rewards your patience. It's tough watching an ETF underperform, but investing is not about quick results. It's about building something resilient. This ETF isn't designed to be a rocket ship. It's a workhorse, and workhorses look boring until the market conditions flip. The very same factors that make SCHD feel sluggish today are the ones that give it a massive edge tomorrow. One crucial factor is interest rates. When short-term rates are high, dividend stocks naturally lose appeal. That's the logic driving a lot of investor decisions right now. But that logic falls apart as the macro environment changes. The Federal Reserve isn't going to keep rates this high forever. Dividend-paying stocks suddenly look more attractive. Some of the smartest institutional money is quietly using this period as an accumulation phase. This is where dividend reinvestment becomes a secret weapon. Many underestimate its true power. Every quarter, SCHD pays you. By reinvesting those payouts, you're constantly buying more shares at different prices. Sometimes you grab shares at a discount when the ETF is down, and sometimes fewer when it's expensive. Over time, this dollar cost averaging on autopilot creates a powerful compounding effect. Let's address the risks. SCHD's exposure to energy is a double-edged sword. It offers upside, but also potential downturns. Healthcare offers stability, but is vulnerable to regulatory changes. Consumer staples face margin pressures. SCHD isn't betting on speculative companies with shaky balance sheets. It's anchored by businesses with strong fundamentals. That quality focus doesn't eliminate volatility, but it does create resilience. Resilience is what you want in an ETF for long-term wealth. You're buying SCHD for the next 10, 15, or 20 years, during which sectors will rotate and market leadership will change. SCHD offers exposure to different parts of the economy: energy, healthcare, and consumer staples. Diversification is about consistency and protection. It ensures one bad earnings report doesn't sink your entire retirement plan. SCHD plays an important role in my own strategy. It's the ballast that keeps my portfolio steady when markets get choppy. Even when it's not dazzling with returns, it's still paying me every single quarter to be patient. The narrative around SCHD today is eerily similar to stories we've heard before. In 2000, value stocks were declared dead right before they massively outperformed. In 2008, defensive sectors became havens of stability during the crisis. Selling during these boring periods is often the worst move. It's like chopping down a tree before it bears fruit. The beauty of an ETF like SCHD is that you don't have to time the rotation perfectly. Just stay invested, reinvest your dividends, and let the cycles do their thing. When they do, it usually happens faster than most people expect. One quarter, the market ignores dividends, and the next, everyone chases yield again. Every reinvested payout builds future gains, while every boring quarter you stay the course sets you up for a bigger payoff later. It's about building a foundation with SCHD that throws off income, compounds steadily, and reduces risk across decades, not weeks. Wealth isn't built in exciting moments. It's built in quiet ones, by holding on to investments and reinvesting dividends quarter after quarter. Underperformance often doesn't mean something is broken. The market's attention can shift, but it always comes back. SCHD has a decade-plus track record of consistent performance across economic cycles, weathering recessions and market rotations. SCHD was built to steadily compound wealth while you live your life. Compounding over time leads to powerful results. Owning 500 shares generates dividends each quarter. Reinvesting those dividends buys more shares, creating a snowball effect. The real superpower of SCHD is the yield on cost you earn many years from now as dividends grow with reinvestment. Let's talk about portfolio strategy. SCHD truly shines when used correctly. The best portfolios usually have both growth and income. Growth stocks offer explosive potential. Dividend ETFs like SCHD provide stability, income, and balance. They complement each other. In my portfolio, SCHD isn't competing with growth. It's balancing it. SCHD's steady income keeps me grounded during market surges. It's the ballast that keeps the ship steady while the sails catch the wind, allowing me to stay invested. Patience is the most underrated skill. Investors underperform due to impatience, selling too soon, instead of letting compounding work. SCHD rewards patience. Understanding boring fundamentals like sector allocation and dividend policy is crucial. SCHD's focus on essential sectors ensures its staying power. Even the risks look different when you zoom out. Sure, energy exposure could hurt if oil collapses, but those risks don't make SCHD a bad investment. They just make it a long-term investment. Quality companies tend to adapt, innovate, and keep rewarding shareholders over long time frames. Institutional investors aren't dumping SCHD in frustration. They're accumulating shares and reinvesting dividends, waiting for the next cycle. Markets are forward-looking and cyclical. Today's laggard is often tomorrow's leader. And that's the bet with SCHD. You might be sitting on one of the most quietly powerful opportunities in your portfolio. The price might not be skyrocketing, but the dividends are still flowing. It's easy to fall in love with the stocks that double in a year, but the investments that change your life rarely feel exciting while they're working. The question isn't whether SCHD will explode next quarter, but whether you're willing to let time and dividends do their job over the next decade. Look back on this boring stretch not as a disappointment, but as the foundation of your financial independence. Patience isn't just a virtue, it's a strategy. It's the reason portfolios grow and wealth compounds. If you found this breakdown helpful, stick around for our next video on how dividend investing can transform your long-term returns.